Let's be real for a second. The world of investing can feel incredibly complicated, almost like it's designed to confuse you. Day trading options, crypto. But what if I told you the best way to build long-term wealth is actually the simplest? You could set up a diversified portfolio in less than an hour, then spend just a little time on it each year. This isn't a gimmick, it's time-tested. It saves time, money, and stress. This is your guide to the 3-fund portfolio. The ultimate beginner's blueprint will cut through the noise. No high fees, no glued-to-screen trading for people who want their money to work for them. Step by step, everything you need, promise. Simplicity, promise. Low costs, promise. A sensible approach. You don't need a finance degree, just willingness and discipline. What funds to pick, how much to put in each one, and how to maintain it with minimal effort. So, what exactly is this magical 3-fund portfolio? It's not complicated at all. At its core, it's an investment strategy that uses just 3 low-cost index funds, or exchange-traded funds, ETFs, to build a broadly diversified portfolio. This isn't about picking individual stocks like Apple or Tesla. It's not about hoping they go to the moon. Instead, it's about owning a tiny slice of thousands of companies and owning bonds from all over the world. The entire concept is built on diversification. Don't put all your eggs in one basket. By spreading your money out, you reduce your risk significantly. The 3 funds are chosen to cover the entire investment universe efficiently. First, the entire United States stock market, and second, stock markets of all the other countries. Third, the bond market, a stabilizer for your portfolio. Combine them and you get exposure to growth at home and abroad, with a safety cushion for when the market has a bad day or a bad year. Why is this better for beginners? Because it removes emotion and guesswork. You set an allocation and stick to it, without chasing hot stocks or timing the market. Let's break down the 3 building blocks of this portfolio. The first, and usually the largest, is a total U.S. stock market index fund. This single fund gives you ownership in thousands of U.S. companies, from giants to small, up-and-coming businesses. It's like buying the entire American economy in one click. When the U.S. market does well, this part grows. The second fund is a total international stock market index fund. About half of the world's stock market value exists outside U.S. borders. This fund owns companies across Europe, Asia, and beyond. Including international stocks adds another layer of diversification. Sometimes U.S. lags while international soars, and vice versa. Owning both smooths returns over time. The third piece is a total bond market index fund. This is your anchor, a source of stability. Bonds are loans to governments or corporations, and they pay you interest. They're generally safer and less volatile than stocks. When stocks crash, bonds often hold value or even rise, cushioning the blow. Bonds won't deliver explosive growth, but they help you sleep at night. Putting it all together, stocks for growth, bonds for safety, globally diversified. You aren't betting on any single company or country. You're harnessing the world's long-term growth. Choose broad, low-cost index funds or ETFs. Specific brand isn't as important as low fees and breadth. Now that you know the 3 ingredients, the next step is deciding your recipe, your asset allocation. Allocation is simply what percent goes into each of the 3 funds. It sets your risk and potential return. The right allocation depends on 2 things: your time horizon and your risk tolerance. A common rule of thumb: 110 minus your age equals your stock percentage. At 30, that's about 80% stocks, 20% bonds. Examples: aggressive 80-20, moderate 60-40, conservative 40-60. Pick what you can stick with them. If a 20% drop would make you lose sleep, increase bonds, even if you're young. Let's use a simple example. Invest $10,000 with 60% stocks and 40% bonds, splitting stocks between US and international. Final allocation: 40% US, 20% international, 40% bonds. So you'd put $4,000 into US, $2,000 into international, and $4,000 into bonds. Hypothetically, US plus 10%, international plus 5%, bonds plus 2%. Your $10,000 becomes $10,580. $580 without doing anything but holding. Next year, returns build on a larger base. Add monthly contributions and compounding accelerates. Over 20, 30, 40 years, steady reinvested gains can grow substantially. This is the slow and steady path that works with patience and discipline. Let's talk about fees, specifically the expense ratio. It's an annual fee, a tiny percentage that compounds against you over decades. 2 identical index trackers, Fund A at 1.0% versus Fund B at 0.04%. Both earn 8% before fees. After 30 years, you might have $76,000 versus $100,000. The difference? Fees. Target well under 0.10%. Ideally, 0.03% to 0.04%. Always check before you buy. Once a year, rebalance. Bring your mix back to target. If stocks run, you may drift to 70-30, more risk than planned. Sell some of what's high, buy what's low, return to target. Disciplined buy low, sell high. 2 ways: do trades, or if you add new money regularly, direct contributions to the underweight fund to avoid taxes and taxable accounts. Pick a date each year, birthday or New Year's. Log in, check percentages, and adjust only if drift is significant. Rebalancing manages risk automatically and keeps you on plan. Pros: simplicity. Set up in under an hour. Manage with an annual check-in. Extremely low cost. Savings compound into a massive advantage. Broad diversification. Thousands of stocks and high-quality bonds worldwide. Easy to understand, implement, and stick with. Limitations: you won't beat the market, you'll be the market, minus a tiny fee. It still requires emotional discipline. Crashes happen, bonds cushion, but you must stay the course. Core message: broad diversification, rock-bottom fees, long-term discipline. Your clear next step: open an investment account at a low-cost broker. Open an IRA or standard brokerage. It takes under 15 minutes. Fund the account, choose your 3 funds, make your first investment. The journey to financial freedom starts with one simple action. Make that action today.